Hi, everybody. Happy Monday. Let me make sure that music is off. There we go. Awesome. Happy Monday, everybody. We're going to jump right in. Today is going to be a little bit different than usual. And the reason being is it's May 2nd. And what we find is that when we get into the market update, LA, Orange, San Bernardino, Riverside County, the numbers are not going to be up to date right now. So everything is a little bit backed up since we're only on the 2nd of the month. If the data was a little bit more complete, I would probably go over it today. But it has not been updated as of yet. So we will look at those numbers next week so that we can go a little bit more in depth into what is happening in the 4 counties. If you're really interested in learning a little bit more of what's going on in the counties specifically, you can review the market update from last week. And then next week, we'll return to kind of looking at what's going on in the counties. What we're going to focus a little bit more on today. So we've gone over some of the bills, legislative updates in the past. I'm going to go over those for you as well, because I think it's good to have these bills, these different legislation top of mind. And then we're actually going to go into a little bit more in depth what is happening as it relates to inflation, what is going on in the economy right now, what's going on with the consumer price index, and what does that mean for you, and what does it mean for your clients? So it's going to be a little bit more in depth here. I do want to note, if there are questions that come up, because this is going to be a lot of information that we're going through in a very short amount of time, and these slides will be available for you to download. With that being said, if there are questions that come up, please put them into the chat box. I'm going to explain as thoroughly as I can. And then if there are questions that come up, I will either, if I can, address them on this call, or I need to go get additional information and data for you. But we're going to talk a little bit about that as well, because I think that that's important for us to look at. So again, for those that are kind of jumping on right now, we are not going through the 4 counties this morning, but we have a lot of information that we're going to be going over today. So let's go ahead and jump right in. Of course, we know that as I continue and as I go through the information, we always want to make sure that we are in alignment with the TCPA, whatever list you are calling on, whatever type of conversations we discuss that you can be having with your clients today. Please remember to scrub your list and comply with TCPA. All right, my friends, with that, I want to start off before we kind of dive into our regular material, a reminder for everyone and why I want to start off with our Y4 C2Ts, because of course, right now, we're really in this kind of mode of culture, right? And what the foundation of our culture is, and really having success through other people, really having teamwork, achieving more win-win. We are right around the corner from our annual Red Day. You're going to see a lot of emails and messages coming out today about that, but we are so excited to be able to celebrate our annual Red Day. And with that, I'm going to note the one team, one mission fundamental item that I wanted to touch on today is this one: be generous. Give, get, do, right? As part of our culture. Please save the date, my friends. Red Day is going to be Thursday, May 12th. There's going to be some things that we are doing beforehand. There's a couple different things that we're doing. So one of those, though, that I wanted to touch on is we are going to be sponsoring a family. So this is a vote with the Agent Leadership Council. We're going to be sponsoring a family, a young couple that emigrated from Honduras. They don't really have family here. They don't really have resources and things here. They came with very little of their own belongings, and they actually just had a baby. So they are being displaced from the room that they are currently renting right now. And so they're looking for other alternatives. We're going to be sponsoring that family to really, one, they need baby items. They need items for their home and wherever they're going to be moving to next. They need a home to move into next. So there's a lot around that, but that's going to be one of the groups that we sponsor as part of our annual Red Day. So no, they have a little baby girl. If there's if you're already thinking about, hey, what do I have available that might be good to donate, we are going to be collecting that in preparation for Red Day. And then on Red Day, we're going to be putting that together as well as some other items. So you'll see a lot of marketing come out about that today that you can utilize, for your own efforts as well as with your clients. If you would like a Red Day shirt, they are $20. Part of the proceeds is going to go to our Downey Cares Fund. So as a donation, and those are going to be available for order. Please talk to Fred or talk to Jose at the front. And that way we can make sure to get your Red Day shirt orders. All right, my friends. I also, before we move on to anything, I got this morning, and we want to congratulate Brittany Jarrell, who I believe is on the call this morning, on being selected as our Inland Empire segment ambassador for Keller Williams Young Professional Network. Super exciting. Congratulations, Brittany. We are excited to see what this opportunity entails for you and to have you representing our young professionals as the Inland Empire as segment ambassador. So congrats. Make sure to congratulate her when you see her, my friends. And then we're also excited. Yeah, absolutely. And we're excited for our other segment ambassadors in the region as well. Mercedes, Joseph, and Jonathan. Congratulations, everyone. And I already see in the chat, we're getting some of those congratulations. Sorry, guys, I didn't get to make this slide look prettier. I just got it about 20 minutes ago, but I'm so excited. All right, we are going to jump right in, my friends. So we're going to start off, like I mentioned, with our legislative, state, local updates. And then we are going to go into more of the economic kind of slides, looking at a lot of the numbers. There's going to be a lot of numbers very, very quickly thrown at you. So just bear with me. And again, if there's questions, please put them in the chat, my friends. All right, jumping right in. When we start off, we always want to look at what is happening with our appreciation inventory. We know that last year in 2021, the median home sales price rose about 14% year over year to an all-time high in 2021. Now, we've seen some really interesting things happen with appreciation. In some, this is decreasing in the median price point. And what I mean by that is not necessarily that the overall sales price is decreasing, but that the rate of appreciation is decreasing, okay? So this is a little bit more where we're able to, we talked about this as we entered into this new year, that we anticipated that the rate at which home prices rose is not going to be as significant or as significant as it was last year, right? What we saw in the last 2 years. And there's a lot of factors that come into play with that. So irregardless, part of that is going to be the federal impact on stimulating the economy. They took a lot of actions, and this is going to kind of preface us for as we go through the slides on what is happening in the economy in general. When we went into an economic, we went into a pandemic, there was a bit of a recession that took place right at the beginning. There was a lot of people that exited out of the workforce. There's a lot of different things that happen. The government will take steps to either stimulate or slow down the economy at any given time. The appreciation in the last 2 years, we saw a lot of overstimulation of the economy. And so that had to do with, there was interest rates all of a sudden were manipulated to be extremely low so that we could still have an economy that was working despite being in a national pandemic. And we got an opportunity to see that in the housing market, where we saw a slight dip, and then we saw a change in our normal seasonality because the pent-up demand was released, but there was also more demand that was created by the government's move to stimulate the economy overall. Now, we also saw that, yes, and I'm sorry for this little error right there, my friends, in terms of the typing here, so ignore that. But again, we've also seen that forbearances, right, there are still some forbearances. There's about 1.3% of all mortgages right now, of all active mortgages, are currently still, as of last week, in a COVID-19 related forbearance plan. So the other thing that we saw is when we went into a little bit of a tightening, a lot of questions came up as, are there going to be a ton of foreclosures? Are there going to be a ton of short sales? What is that going to look like moving forward, right? The thing is that when there's a lot of equity that exists in the market, and all of a sudden you have a moratorium on foreclosures and a moratorium on evictions, that stopped there from being a major influx into the foreclosure market. I'm not going to say that they're not foreclosures. There absolutely are some foreclosures that are still coming out. We have some pent-up foreclosures from the last couple of years that are hitting the market. But what we know to be true is that right now we are seeing that most financial institutions are taking advantage of California mortgage relief, especially in California, with the forbearances that are active. What we also know is that following 2007, 2008, there was about 10 million homes that went into foreclosure in the United States. There are less than 1.3% of all active mortgages right now are in a forbearance plan. So when we really look at it, and it's a very small amount when we look at, so look at this right now, 691,000 mortgage holders remain in a COVID-related forbearance plan. We juxtapose that to the 10 million that were in foreclosure following 07, 08, right? That time period, the number of potential properties that may go into foreclosure is nowhere near as high as it was. And so it's not to say that there's not opportunity in that market, but what it is to say is the level of opportunity is nowhere near in that particular segment of the market, right? In that particular segment is nowhere near what it was. And that comes into play because what happens? Supply and demand affects appreciation, right? Supply and demand affects home prices going up or down. And what we know is this idea that all of a sudden there's going to be an influx of foreclosure inventory that is going to decrease prices is not necessarily the case, not to the level that it was in 07, 08, 09, right? Type scenario, where all of a sudden you see an influx of properties, more supply than meets the demand. And so that impacted prices. Now, a couple other things that have happened in terms of some of the things that were created to create inventory. We've been talking a lot about Senate Bills 9 and 10. Senate Bill 9 and 10 allowed for the approval of additional, right, higher density housing in what was traditionally considered lots that were originally zoned for single family residents, right? It's the attempt that California specifically is making to create more inventory, because the other thing that we know is that in the United States, we are so underbuilt, meaning that we are behind on new construction to the point that if we continued to build at the rate that we are currently building, it would take approximately 20 years to catch up. That's a lot of underbuilding that has occurred. And so California put in place a couple of Senate bills, Senate Bill 9 and 10, which are geared towards allocating traditionally either properties that are currently single family residents or land that has been zoned for SFR to build up additional units, right? So this is kind of what those two Senate bills entail. Now, that is statewide. Doesn't mean that everybody is willy-nilly. Now you can go in and build whatever you want on these SFRs. No, every single city is also creating their own little ordinances around this, around how they're implementing these Senate bills. And then the state is monitoring that to make sure that in their mind that still feeds into the intention of these two Senate bills. The secondary part is going to be the California housing element. So you guys hear me talk about California housing element quite a bit. A couple of things that we're seeing is an impact of California housing element. What it is it is a statewide, essentially a statewide mandate, which says in California, after we do the census, which was completed last year, California also does an environmental survey. And what they say is based on this census data. So we did this report, we got the census data, which is giving us what changes there are in the demographic of our state as it relates to population growth, and also as it relates to what segment of our population is lower income and needs affordable housing, how much median housing, how much higher price housing do we need? What does this look like? They do an environmental survey to say, hey, yes, this city can sustain a mandate of X amount of housing that needs to be created. And then they say, okay, city, you're required to now build X amount of homes over the course of the next 8 years into your infrastructure. The cities then went the first quarter of this year, so they received that mandate at the end of last year. They went this year and they said, okay, how do we build this into our general plan? So general plan is going to be essentially a plan that each city has, how they're running their economy, what the plan is, building all of these different things. And they build in this new mandated allocation into their general plan. So as an example, the city of Downey, we've talked about this a few times. We know that as of right now, there is a proposed construction by the County of Los Angeles, who owns land, the Rancho South Campus land. And that part of this construction that they are working on, part of what they're creating over at the South Campus is going to be a minimum 700 homes to go to the California housing element allocation for the city of Downey of 6,500 homes. Why is this important? A couple reasons. Now we have an influx of homes that are coming into the city of Downey. Same thing is happening as an example, Montebello, right? We have a lot of new home developments that are coming out in Montebello. There's construction happening in Pico. Any city, right? Any city that you may farm, if you live in a particular city, I highly encourage you to please look at your housing allocation, right? And so that you can really have an understanding of what is happening in that particular city as it relates to new construction. Look at the general plan to see where that new construction is potentially going to be coming from as well, right? That's kind of what we look at when we look at that housing element allocation. But also we think about what is the opportunity that creates. So if there's 700 new homes that are being created in a small pocket here in the city of Downey, might that not impact the neighbors, right? The neighboring areas as well. Might there be some changes where some people say, hey, you know what? I don't want to live next to high density housing, and so I want to sell. Or, hey, you know what? I think there's opportunity here. Maybe I want to buy in this particular pocket. Or maybe there's commercial opportunity. We need gas stations. We need grocery stores in those areas when all of a sudden you're dealing with housing for 700 families that creates an influx of need on that infrastructure. So this is why the housing element is so important, is because we know that new home development and construction is going to be a really big market as we move into this next kind of decade right now. I highly encourage, again, please look up California housing element in your area, in your neighborhood. And that way, we can, you can see what that level of opportunity is. I want you to explore that. I want you to look at the general plan for your area and understand what impact that's going to have in your particular city, either that you live in or that you farm. Now, with that, we also have some legislation that we want to keep an eye on. So this is new legislation that we want to monitor. One of those is AB 2179, which is this one already came into effect. So this may already be impacting you. And I have gotten a few questions on it. This protection was written into effect at the end of March. What it is it extended eviction protections through June 30th, 2022. So what happened is there was, we had the phase 1 and phase 2 tenant eviction plan, right? The tenant protection bill that was signed into law. This was an extension because there was supposed to be an expiration happening in the phase 1 at the end of March. This is now extended that to protect those eligible tenants that applied for assistance, for rental assistance prior to the end of March, are shielded from eviction. So I'm going to note that's one to pay attention to in the event that you have a client that is currently looking to evict. this may impact them as well. AB 1771, the California Housing Speculation Act. This bill was recently introduced by Assemblymember Chris Ward. It was about a month ago now. What it would do, it would impose a 25% tax on investors' net capital gains from the property's time of purchase until final sale or exchange within 3 years. Meaning that if you have a short-term investor or someone that stays in the property for less than 3 years and decides to sell, they would be impacted by a 25% tax. Now, the bill itself, there's other parts of it, and it's currently getting proposed. CAR is strongly opposed. The reason being is that may stop certain sales from occurring. It also has a 7-year time clause as well, where the tax is not 25%, but it still puts a tax in for 7 years. We know that the majority of homeowners tend to move out within 7 to 10 years is kind of that time frame, which is partially why they're putting it from 3 to 7 years. And yet we know that things happen, right? Jobs change or something else happens in the market and somebody wants to sell. Might this impact or stop somebody from selling their home if they know they're going to be hit with a pretty heavy tax on it? It could, which is part of the reason that the California Association of Realtors is strongly opposed, is they feel that this would kind of stop the number of sales that occur, because now homeowners are essentially in their mind being penalized for selling within that period of time. So this is one that is currently on the table. AB 2170, CAR, the California Association of Realtors, is sponsoring this bill. What this bill is really geared towards is in the event of, as an example, foreclosure sales. So what happens when you have a foreclosure? Depending on the financial institution, if the foreclosure is under Freddie or Fannie, they would basically, you take the property back as a potential asset, right? Is kind of what that looks like. With that being said, this would prohibit, right? This would prohibit government-sponsored entities or federal institutions from selling these sales in a bulk sale or for institutional investors. So what does that look like? We're seeing a lot more institutional investors coming back into the market. We've been watching a couple over the course of the last 2 years. Anytime we see institutional investors make a major move, that's important for us to watch. Institutional investors will do something like this. Instead of a home being sold one-off, right? Let's say there's 1,000 homes. Instead of those homes being sold in 1,000 sales to 1,000 different families, they're bought in bulk to an institutional investor. What this assembly bill would prevent is that from taking place. They'd say, hey, you know what? We are not going to sell these to institutional investors. We are going to be required to actually sell and offer this to true potential homeowners at least for 30 days before we package it into some type of bulk deal. So CAR is sponsoring this bill because they believe that it will create more opportunities for homeowners to potentially buy in a particular area. Okay, a constitutional amendment. So ACA 14, the Housing Opportunities for Everyone HOPE Act. This is a constitutional amendment that was introduced in the California legislature. Going a little too quick. And this is more geared to allocate a percentage of the general funds tax revenue, 5% of the general funds tax revenue, to be allocated and transferred for 10 years to address housing and homelessness. So this is essentially just allocating funds from the general funds bracket into this new kind of initiative. What they're estimating that this would set aside $10 billion in housing funding each year. Now, this is setting aside the money, and the assumption is that would be enough money to house 50,000 people who are homeless or build an additional 40,000 affordable housing units each year. How this money is going to be used, that's still kind of up in the air, but this is what the proposal is as of right now. All right, economic risk that we continue to watch. I'm not going to go too much into this right now because we're actually going to look at this in the slides themselves. So I will come back to this. Okay, so we're going to talk a little bit about what is happening in the market as a whole. There's a lot of slides here. There's going to be a lot that we go over here, but I want to kind of just position this in, we're digging into some economic numbers, some economic factors of what is happening in our industry, what is happening in the economy, so that you have a better idea of how this impacts home sales. What are some of the things that we may anticipate? What are some of the changes? And this is from updated slides from Gary Keller's market update and state of the industry update that he does in February. This was updated this past month for a leadership event that we were at. So I wanted to share these slides with you. The first is going to be unemployment. So as we look at national unemployment, we're also going to look at monthly unemployment. This is a great place for us to start, right? We can see where we were in 2019 at a very low unemployment rate of 3.7. If you look at this from 1990, right? I want you to really take this into perspective. In 2019, right before we hit the national pandemic, we were at the lowest rate of unemployment that we have been. That was very healthy for our economy. 2020, this jumped to 8.1, right? So we go into a national pandemic and there was a lot of layoffs. There was a lot of different things that occurred in the market that we saw. And all of a sudden we saw our unemployment completely jumped to 8.1. As we entered into 2021, the annual rate of unemployment in 2021 dropped, right? It dropped to 5.4, which is a little bit higher than where we were in 2015, right? So kind of look at the trend that we're seeing. It was still high, but not as high as it's been in some years, right? Now we go into our monthly unemployment. Coming out of 19, very, very low, right? The lowest at a 3.5. We saw a major jump in March of 2020. So the month following, right? I'm sorry, that's April, right? In April of 2020, all of a sudden, national pandemic, right? Everything goes on a full shutdown. Nobody's able to go into work. We saw the highest amount of layoffs, the highest amount of unemployment at 14.7%. And then we saw this slowly kind of trickle down. As of March 2022, the unemployment rate is at 3.6. So we come back over here, we look at where we were in 2019. This is an incredibly healthy rate of unemployment, right? Part of the way this happened, so I want you to look at this. We went from 8.1 to 5.4, right? During COVID, we look at this right over here. During COVID, look at this, 14.7. So I want to note a couple of things. When unemployment jumps up like this, and unemployment was very, very high, even for 2020, even 2021, it was considered higher than normal. The government took motions to stimulate the economy, right? To drive the economy, to bring back employment. And it was overstimulated a little bit. So we can see that unemployment has dropped down to 3.6. And yet there are still a lot of open jobs. We're seeing this all over the market right now, where we're seeing people posting saying, oh, I can't get anybody to come back to work, or I can't get people to do X, right? And yet the unemployment rate is as low as it was in 2019. Now we look at the GDP, same thing, right? In 2019, so the GDP is the gross domestic product in the United States. GDP in 19 was at 2.3. It dropped in 20 to 3.4. The lowest it had been before that was in 09. So following again, right, we started to see this drop occurring from 2005, 2006, 2007, 2008 to 2009. But this was a gradual drop versus what we saw here was straight drop, right? Down to 3.4. So the lowest it had been throughout this entire time period. And in 2021, the highest that it had been throughout this entire time period. Because what happens? The government makes motions to stimulate the economy, right? When we never want to underestimate what the government is willing to do to keep the economy as healthy as possible in both directions. So we're going to talk about that as well. And so what did they do? They said, hey, you know what? We're at a negative 3.4. How do we stimulate this economy? We need to drive the cost of goods. We need to drive more sales. We need to drive more, people need more things. Let's bump it up. We lower interest rates. We do all these different things. And now we get up to a 5.7. Quarterly, we can see that as well. So look at this major drop. It was as low during COVID. We went to as low as 31.2. That is an extreme decline. And look at this extreme bounce back in the next quarter, right? From Q3 to Q4. Again, stimulation of the economy. The other thing that's really important to look at is that right now, we know that people are gainfully employed and they are spending money like crazy. Human beings do not spend money on the basis of economic cycles, okay? Human beings do not spend money on the basis of economic cycles. They don't go, none of you are going every day and saying, hey, I want to go look at the GDP today. I want to see what the rate of inflation is today. And that's going to determine whether I go buy my toothpaste and all these different things at the market, right? It's going to determine whether I go and decide to buy a house this year, right? Most people are not thinking that way. They're not saying, hey, I'm going to go look and see what's happening with the economy, and that's going to determine whether I do X, Y, and Z this year. What they say is something like this. They buy on the basis of life cycles, okay? They buy on the basis of life cycles. What they say is this: oh, we just had a new baby, so we need to go buy baby items at the market because we need it. We're not saying, oh, you know what? I'll buy baby items in 3 months when all of a sudden the cycle changes, or I'm anticipating that inflation does X, so I'm going to buy then. Nobody's saying that. They're saying, hey, I have a baby. I'm going to go buy those items now. Hey, we had a baby. Maybe we need a bigger car. Hey, we had a baby. Maybe we need a bigger house. Or, hey, I just got married. I want to go buy a house now, right? Or, hey, I just got divorced. I need to sell a house now. All of these different things are things that happen in life. Or, hey, I graduated college, and so I'm moving out of where I was, and now I need to move someone else. We make decisions based on life cycles, right? Not on the basis of what is happening here. At the same time, the government says, hey, this is way too low. What do we do to stimulate this, right? What do we do to stimulate this? Or, hey, the inflation is much too high. So look at this as well, right? Where we were in 2019. And look at this in the 90s, right? Where it was, okay? Now, in the 90s, we look at this, we were at 6.1 in the CPI, 5.2 in the core CPI, and then it drops. What happens? Government gets stimulated to drop, right? It gets pushed or pushed into the opposite direction here. Same thing, we look at 06 and then 07, we saw a jump here, and then this major drop in 08. But these drops are very, they're very pronounced, because generally what happens is you see a spike, they want to drive a drop, right? You see a spike, they want to drive a drop. Generally with the government, so there's a couple things that happen with the government. They own about a third of the stock market. The bond market is about 4 times the size of the stock market, and the government owns a lot of that too. In times of depression, that gets buoyed up. In times of inflation, the government sells to drop it down. So we're going to talk about that, because right now, the inflation, the CPI is at 7.04 and 5.5 for the core CPI. This is too much, right? It's incredibly big right now. What we are already seeing, and if you are watching the market right now, what have you seen? You've seen certain stocks drop, right? I got the calls over this weekend from my parents asking me if they should move their retirement funds now, because in the span of a period of time, what happens? Stocks drop. We're seeing that right now. Now, at the same time, what are we also seeing? We saw prices, especially in homes, go up because of appreciation that has occurred. But you're feeling this, and you go to the gas station, and gas is more expensive than it's been. I had never been above like $60, $70 on my car. And now when I go fill up my tank, it's over 100, right? That's what we're seeing with inflation. You go to the store and everything that you buy has done what? It's gone up. That's what we're experiencing with inflation. We look at it monthly and we can really see this driving up, especially in 2021. We're seeing that extensive growth when we had been at 1.7, 1.5 in January of 2019. Okay, this is a little bit more complicated. This is the inverted yield curve, 10-year, 3-year spread. What I want you to look at here, though, is we look at what happens in times of recession, where we see this go up, okay? Now, like I said, in times of depression here, so right here, you could see this one right here, 82, 83. We can see this here in the 90s. We can see this here in 2001, right here, right? Look at this one. This is the one that most people remember, right? 07, 08, right here. But we see that drop happening here. We see that drop happening here. We see that drop happening here, right? 07, 08. And then right over here, we see that drop as we entered the pandemic. A little bit different this time around, right? This is a little different. What happens? The government says in times of depression, they buy in the stock and bond market, and they manipulate the market to buoy the economy up in times. And what happens? So we see where things get buoyed up, and all of a sudden we experience inflation, but at the same time that sometimes we're experiencing other things. Those are considered the recessions, right? We can look at that in a 2-year spread. So see that here as well, right? Okay. And then we look at the mortgage rates during that same period of time. So let's go back to that. Okay, inverted yield curve, where we're seeing what is happening with the economy. We're seeing the declines and where the considered recession is at. And then we see this happen in those same time periods following with where the mortgage rate is. So look at that. Mortgage rate goes down here, up, and then goes up during that recession period. Look at this mortgage rate in the 80s, that increase, right? Above that 5% mark. Right here, it's at between the 4, right? This was a little bit lower here. Here we are in 2020, but our rates have been very, very low. So what we know is that right now we are seeing an increase, right? We are seeing an increase in rates, right? We're seeing that in the mortgages. That is part of the government's move to help the economy, because inflation is considered to be too high right now. Now we look at that in terms of our home sales. So we know that it's in this period of time leading up to what was considered a recession or a market crash, okay? There was 28.2 million home sales that occurred from 2002 to 2006. Right before we saw what was considered to be a market crash in 07. We look at this, now we're looking at our home sales within the past few years, 2018, 19, 20, 21, and what our projected sales are for 22, also 28.2 million sales. This is just, we're creating juxtaposition, right? We wanna be able to see what is happening in the economy, because what happens in changes in the economy, I know the numbers can be a little bit complex and it's a lot to kind of take in. Here's the biggest part that I really want you to think about on here. And I see, so I will answer that. That's a great question on how this is going to affect the market and how it's going to affect the agents. What is so important right now is that we've seen an uptick of sales for the last 2 years. Now, when money is cheap, interest rates are so low, right? They've been 2-3%. If we're looking at a spread of 100, we've been talking about this for the last couple of years. The only way for them to go is up. We are anticipating that interest rates should hit about 7% by the end of the year. So again, I'm going to note this one here. I want to talk about this seasonally adjusted. So we'll go through the slides and then I'm going to comment a little on this. Home sales right here, we're looking at 2020, 2021, right? And then you have 2022. So where we're seeing those home sales at in basis. 2021, again, was a little bit of that anomaly year. Right, we saw some differences in 2021 from pent-up demand. So look at 2020, April, May, right? Obviously, it's lower. What happened? We got a national shutdown. Most of us were, what happened during this time? There was no open houses. There was a lot of things that couldn't be done during this time frame. So we saw those sales decline. They buoyed up a lot in 2021. And then right now they're kind of coming down a little bit. Not a lot, but down from what they were in 2021 in 2022. Okay, same thing, we look at home prices. This is another side that I'd say is going to be really important to look at, right? We look from 1990 to 2022. This is the annual median home price in the thousands each of these years, okay? We know that what happened, we went through a recession here. Look at this little kind of this curve that happens. We went through what was considered a recession, 07, 08, 09, 10, 11, 12. But in 12 is when the prices started buoying back up in home prices. And yet, when we look at 2021, what we know to be true is that regardless of when somebody bought their home, if they held it long enough, they experienced appreciation. So let's look at that, because this comes up when we're talking with buyers that are wanting to say, hey, I want to wait. I think the market's going to crash. I think X, Y, and Z, right? So let's look at that. If somebody bought their home in 2003 and then they experienced this crash, right? And all of a sudden it's going down. At what point did their home return to its value? 2013, 10 years. 10 years and they start experiencing a gain. So they hold it long enough, they experienced a gain. Same thing, we look at 2005 and we go along, we're looking at about 2016, 2017, right? So maybe about 11 years, depending on what price point they bought. But what I'm looking at is the average. If somebody holds an asset long enough, it returns to value even if the market crashes. Now, here's what we're not taking into account when all we look at is these home prices on an annual basis, right? Is okay, let's say I bought my home in 04, the market crashes, and in order for me to return to value, I have to hold until 2014. I have 10 years before my home returns to value. Here's the difference between somebody that owns and somebody that rents. Is now I have an asset that I own that is actually appreciated in value, even though I had to hold it longer. Here's the other thing. If during that time, I have an asset that in the event of emergency, I can potentially borrow against, I have tax incentives. So this is something for them to talk to a financial advisor or CPA about, but I have tax incentives or tax benefits that come from owning instead of renting is the next part of that, right? Here's the next piece. Is with that particular asset that I hold over that period of time, what happens? My money is actually going into something that I own versus going into something that I rent. Meaning that I'm contributing to my own equity. Those payments that are made over that 10 years goes to me instead of my landlord. Now, had I not purchased, and in that 10 years, I see that market do this and this, and I come out on that other side from 04 to 14, what did I not gain by not purchasing, right? I didn't get those tax benefits of having ownership. I didn't increase my equity over time, and I spent the money anyways, maybe not the same amount of money because we know, of course, there's mortgage insurance and we're paying part of the interest, et cetera, right? But I'm spending a good chunk of change anyways on a rental. So when we look at this and we're talking to our clients about this and what happens in the market, being able to showcase something like this and having them really understand that even when the market goes down, it goes back up over time, and the long-term average on a home price appreciation is 4%, that there's an element of gain here in the long run for them. That's important, right? That's important for us to understand how to communicate and how to talk about what's happening in the market right now. And then we look at monthly, right? We can see these interest rates from up here, they're going down. We can see that fluctuation that we've experienced in the median home price in the United States here as well. Now, days on market, we've also seen, right, at the beginning of the year in 2020, the days on market were much more extensive. We saw a major drop. This has to do with the amount of inventory that we have available to us. And then we look at 2022, and we're still seeing that decline in days on market because there's not a lot of inventory. Again, now this looks at our inventory trends. The most inventory we had was in 2008. Not a surprise considering what happened in 2007. Right, we saw that influx of inventory. 2021, 2.3, lowest inventory throughout this time frame, right? A balanced market is 6 months of inventory. This is where we've been. It's been very few times that we've moved into what would be considered a buyer's market, was really only coming out of the last recession, right? Is right over here. Right here, we're at 2.3 months of inventory. We look at monthly, what we've experienced from 2020, 2021 to where we are in 2022. Our highest month was May, but we've seen these major dips right over here. Now, in 2021, we did see a little bit of that curve up, but the highest month was 2.6 in July. Okay, right now we're about 1.6, 1.7 months of inventory nationally. If you guys recall, when we go over each county, we've been less than 2 months of inventory each time for each of the counties that we look at. And then of course, looking at our mortgage rates from the 70s. So this is another thing that's going to be really important for us to look at. We look at the 80s. I've talked about this, where I have family that bought in the 70s and 80s, and they bought at extremely high interest rates. Highest interest rate that we've seen is 16.63, and that was in 1981. This historical average from 1972 to 2020 is 7.81%. That is the historical average. So us having been as low as we have, and then if we look at the historical average from 1990 to 20 was at about 5.97, a little less than 6%. We have been very, very, very low, but it hasn't always been this way. So this is the thing. The reason that I point this out is because sales have happened throughout every single one of these markets. The interest rate is not going to make or break the sale. What it is going to do, and what we talk about a lot, and what you guys are going to hear us talking about a lot, is that we're going to be talking about shift. One of the chapters in Shift talks about when we experience any type of market change, what happens? We have to go out and find the ready, the willing, and the able. What happens when there's a market change, when there's interest rate changes, is that you may have individuals that are ready and willing, but they might be unable unless they get a little bit more creative. One of the other chapters that we're going to be digging into a lot in Shift is creative financing, right? Sometimes people are ready and willing, and they need some help with getting creative around the financing. That's where we talk about, you're going to hear this term in the ARMs, mortgage ARMs, is adjustable rate mortgages, right? That is coming back. We saw that a lot in some of the previous markets, where what happens is, in order to decrease the interest rate and make things a little bit more doable for somebody to move forward with the purchase, what happens? Maybe instead of a 30-year fixed mortgage where they lock in that rate for 30 years, maybe they're on a 10-year fixed mortgage or a 15-year fixed mortgage with an adjustable rate at the tail end. Now, it's important to understand what that means, that means they're getting a fixed mortgage rate for a fixed period of time, and then it adjusts to whatever the market mortgage is next. And we know that the majority of people will refinance their mortgage multiple times through the course of that 30 years that they own their home. So it's just having an understanding of what happens, right? What does that mean? What are some of the other options for creative financing? You're going to hear us talking more about things like seller financing. I'm starting to get more questions on seller financing. That's when the owner has so much equity and maybe doesn't necessarily need all the money up front, that they're willing to be a little bit more creative on them financing the property with the home as the asset, that should the client default, the purchaser default, that they regain that asset, and yet they're making money throughout it, right? There's a lot of different creative things that we will talk about, because as we see mortgage rates, the question that I got in the chat was, if there is a recession or whatever happens in this market, is how does this impact real estate agents? Well, it impacts us because our level of skill set needs to increase, right? And our level of being able to problem solve needs to go up, which is why we're going to be so focused on this particular book. And please, if you don't have a copy of this is a great one to see Fred about getting a copy of, because this book is going to be part of our manual anytime we are in a market correction, right? Anytime we're in any type of shift in the market. Now, does that mean that there's not opportunity? No, there's plenty of opportunity that exists in the market, but it's looking for those that are ready, willing, and able to move forward, right? Okay, so mortgage rates monthly, we've seen these fluctuations that have happened since 2015. Highest we had been at during that time frame is actually right over here, as we exited 18 to 19. We are right now currently at the highest that we've been since 2015. With mortgage rates, we were about, I didn't check it this morning, I know we were about 5.5 last week. I did not look this week as of yet. And yet, again, we're anticipating hitting up to about 7, because the feds are being pretty aggressive right now in increasing those mortgage rates. I do encourage you, if you have pending clients right now and you have not had their mortgage rate rechecked or updated in the last 15 days or so, it's a good time to get into contact with your mortgage professionals. What you would hate to have happen is that you get your client into escrow and then find out that they no longer can move forward on that property. We do see that happen. That was a great question in the chat. Are there any, I'm going to leave it to you guys if there's any other questions with that. But what I will say is this: when we looked at the short-term and long-term yields, I know that is going to be a little bit confusing for you. The biggest thing that I want you guys to kind of understand is we also see, right? We also see that in one of the predictors of where the economy is going is also public sentiment, right? If enough people think that the price of home is too high, they will stop the market based on their opinion. Why? Because they will stop buying. What we are not seeing right now is enough people stopping to buy, right? Or stop buying. There's still a lot of people buying. I know so many people that said, oh, you know what? I've been waiting to buy a car. I just put in an order for a car, or the new Tesla, right? Has been big right now. Oh, I'm buying a new car. We know individuals right now. I'm talking to our mortgage professionals. I'm talking to you guys about this. And you're saying, hey, you know what? I have a client and they said, yeah, it's fine. The interest rate is fine. I just want to buy something right now, right? I want to lock something in. Until they think that that the price of homes is too high and stop purchasing, we're going to continue to see mortgage rates go up, because this is the government's method of slowing down an economy that is contributing to extremely high inflation right now. That's part of what we look at, right? Again, we also know we have a huge deficit in terms of the number of new homes that are being built right now. So what I will say is this, is from everything that we went over, when we talk to our clients, the one thing that I want you to recognize when somebody asks, is it a good time to buy? Is over time, it is always a good time. Over time, it is always a good time. And I want you to really think about what that means, right? The other thing I want to note is that we are not fixing to just look at what is the market that we're in. Our goal, and why I want to share why I wanted to share this data with you, why I wanted to go over this, why shift is sitting on my desk now and isn't moving, right? It's because our goal is that we are thinking about our business at a high level. Just because we run small businesses doesn't mean we should have small thinking, right? We want to have big thinking, and we want to be prepared for the market that we are going into. And that's what these skill sets are going to be designed for. That's why Pavan did his pricing class last week, which we did record, because that information is going to be crucial in what we're doing now. Okay, so you're going to hear us go in a lot of it. It's also why, so I noted we launched our Future of Floor Time program. My friends, I know some of you attended our informational session on Friday. We will do one more informational session this month. It'll be this Friday, right? This Friday at 10 a.m. If you are interested in getting into this program in this month, right? In this month, I need you to attend that informational session. If you have already attended an informational session and you would like to proceed with the program, please make sure you message me directly, and then I confirm that you are in the program, because there will be another session that is just for onboarding that group. We will add an additional 5 individuals to the group this coming month, and then it'll be closed for another 30 days. So we will do info sessions every month. I go over everything, what kind of leads are coming in. I will note we've got some pretty significant leads coming in. One of the agents in the program, and it's been going on for 1 week, just let me know that one of the clients that came in through our Future program lead is looking at putting a offer on a $1.5 million land deal. So there are some good leads that are coming in out of this program. So please, my friends, if this is something that is of interest to you, 10 a.m. on Friday, and let me know if you're going to be coming in as well. Okay. And then a couple other things, a reminder for those of you attending the KW Stella 6-Figure Plus program. I believe there's 3 or 4 more sessions over the next few weeks on Thursday afternoon, 6:30 to 8 o'clock. We are also going to be doing another course on using podcasts for lead generation. That will be next week, next Friday at 10 a.m. So this week at 10 a.m. on Friday is going to be the Future of Floor Time program. Next week on Friday, we're going to be talking about using podcasts for lead generation. The other thing I wanted to let you guys know, Keller Covered, the product by which you can help your clients save on insurance, home insurance, right, is now available in Command. When you open up your opportunity, you can actually send your client an invitation to Keller Covered, right, to potentially get a extremely low priced insurance. Why? They get multiple quotes through Keller Covered. What happens is it gets sent out to a marketplace that is competing for the clients of 190,000 agents nationwide. And so they are going above and beyond to make sure that your clients are getting the best savings possible. So there is a video for it. We will send that out. And then last but not least, a reminder for the various segments that exist. You guys noted we have different segment ambassadors for our region now. We have quite a few different segments that are going to be ready and available for those of your clients that have interest in potentially getting involved. With that, my friends, I know that's a lot of information. Please make sure that you have your red day marked for the 12th, right? May 12th. Keep an eye out on your email and all the announcements that are going to be going out on that this week. With that, my friends, I will talk to you later. I hope you guys all have a good one. Bye-bye.
Thank you, Monica.
Of course.